what if the next major move in gold is not going to be triggered by inflation at all? What if the real catalyst is something much bigger, a growing confrontation between geopolitics, government debt, military spending, and confidence in the financial system? That is the question raised by this latest geopolitical argument, and if you look at it purely as a political debate, you can easily miss the market story underneath it. Because for gold and silver investors, the most important part isn't which politician wins, which government survives, or which geopolitical strategy ultimately succeeds. The important question is much simpler. Who pays for the geopolitical system? And what happens to the dollar when the cost keeps rising? The speaker in this discussion argues that the United States has developed a deeply embedded military-industrial structure in which successive administrations continue policies of military expansion and geopolitical confrontation. He connects that system to Wall Street, large technology companies, the energy industry, defense contractors, and the broader billionaire economy. These are the speaker's claims and interpretations, not independently established facts from the transcript, but there is one part of the argument that deserves serious attention from every macro investor: debt. According to the speaker, wars and military commitments are increasingly being financed through borrowing rather than directly through taxation, adding to an already enormous government debt burden. And this is where geopolitics becomes a bullion story, because markets eventually have to price the cost of government decisions. If governments spend more, they need financing. If financing needs increase, governments issue more debt. If debt issuance increases, investors have to absorb more treasury securities. And if investors begin demanding higher compensation for holding that debt, yields can rise. Now, suddenly, we have a chain that has nothing to do with a gold mine and everything to do with monetary policy, geopolitical spending, more fiscal pressure, more borrowing, more treasury supply, higher financing costs, greater pressure on monetary policy, and potentially more demand for assets that exist outside the traditional sovereign credit system. That is where gold enters the story. Gold is not a government liability. A treasury bond is. Gold doesn't require a government to make an interest payment. A treasury does. That doesn't mean treasury securities are suddenly unsafe or that the dollar is about to collapse. It means the market has to continuously evaluate the credibility and sustainability of the system supporting them. And this distinction becomes particularly important when geopolitical tensions are rising. The speaker argues that the United States has pursued a strategy of maintaining global primacy and using geopolitical pressure against major powers, including Russia, Iran, and China. He links this argument to Zbigniew Brzezinski's 1997 book, The Grand Chessboard, and specifically to the concept of geopolitical pivot states. Again, we don't need to accept every part of that interpretation to understand the financial implication. There is a much broader macro question underneath it. What happens when the world's largest economies increasingly view each other as strategic competitors? Because that changes trade, it changes energy flows, it changes defense spending, it changes supply chains, it changes reserve management, and eventually it can change the way central banks think about money itself. This is why the Russia-China-Iran relationship matters to bullion investors. The transcript argues that decades of U.S. pressure have failed to prevent these countries from resisting American strategic objectives and instead have contributed to deeper geopolitical alignment. Whether every part of that claim is correct is a separate question. But from a market perspective, the possibility of a more fragmented global financial system is extremely important, because the more fragmented the world becomes, the more complicated the reserve system becomes. And when countries become less comfortable depending entirely on another country's financial infrastructure, reserve diversification becomes more important. That is where gold has a unique role. Gold doesn't belong to Washington, it doesn't belong to Beijing, it doesn't belong to Moscow, it isn't issued by a central bank, and it doesn't depend on a foreign government's promise to repay it. That is precisely why geopolitical fragmentation can create a structural argument for gold even without a conventional inflation crisis. Think about it this way. If the world becomes more peaceful, governments can potentially reduce emergency spending, trade can normalize, supply chains can become more efficient, and fiscal pressure can ease. That environment can be relatively comfortable for traditional financial assets. But if geopolitical competition continues intensifying, governments may have to spend more on defense, energy security, strategic industries, infrastructure, and supply chain resilience. That spending has to be financed somehow. And eventually, investors begin asking whether fiscal policy itself is becoming an increasingly important driver of inflation, yields, and currency risk. That is the point where the gold story becomes much bigger than the Federal Reserve. The Fed can influence short-term interest rates. but it cannot independently solve every structural, fiscal, and geopolitical problem. And that distinction matters, because investors often watch the Fed as if every major market movement begins and ends with one central bank meeting. But what if the real pressure is coming from somewhere else? What if Treasury issuance keeps growing? What if geopolitical spending remains elevated? What if governments continue borrowing to finance strategic competition? What if the global economy becomes increasingly divided into competing economic blocks? Then the market may eventually have to price a completely different risk premium, and gold could benefit from that repricing. But there is another side to this story. If geopolitical conflict creates a powerful rush into the US dollar, gold can initially struggle. That is the paradox. During a period of extreme uncertainty, investors may seek dollar liquidity first. The dollar rises, treasury demand can increase, risk assets fall. Gold may become volatile, but if the crisis eventually creates expectations for easier monetary policy, larger fiscal deficits, higher inflation risk, or greater distrust in sovereign assets, the second phase can look very different. That is why geopolitical risk does not automatically equal instant gold upside. The transmission mechanism matters, and this is where I want to take the analysis further. The question isn't simply, will another war make gold rise? The better question is, what does prolonged geopolitical competition do to government debt, currencies, inflation expectations, interest rates, and central bank reserve strategy? That is the real macro chain. And if that chain remains intact, gold doesn't need a dramatic financial collapse to benefit. It only needs investors and central banks to gradually decide that they want more diversification away from concentrated sovereign and currency exposure. Silver adds another layer. Because unlike gold, silver is not purely a monetary asset. Silver has substantial industrial exposures. So if geopolitical competition accelerates investment in energy systems, electronics, infrastructure, defense technology, and strategic manufacturing, silver can potentially benefit from industrial demand as well. But if geopolitical conflict produces a severe global recession, that same industrial exposure can become a weakness. This means gold and silver may respond differently to the same geopolitical shock. Gold can respond primarily to monetary and financial uncertainty. Silver has to balance that monetary demand against the health of the industrial economy. And that difference could become one of the most important themes for precious metals investors going forward. But before we get to silver's potential upside, there is a much bigger problem hiding underneath this entire geopolitical strategy: the debt. Because the speaker argues that the United States is building an enormous financial bubble on top of debt, military spending, and inflated technology valuations. He also warns that this could eventually contribute to a major financial crisis, although he explicitly says he cannot predict when such a crisis would occur. That uncertainty is important. Nobody can reliably tell us the exact date of a financial crisis, but we can watch the conditions building underneath the system. And if those conditions begin to deteriorate, gold could become one of the most important signals in the market, because gold doesn't just respond to what the Fed says. It responds to what investors believe about the future of money. And right now, the geopolitical debate is raising a question that every serious macro investor should be watching. How long can a country maintain global strategic ambitions while simultaneously carrying an enormous and growing debt burden? If the answer becomes increasingly uncomfortable, the implications won't stop at Washington. They could move into the treasury market, then the dollar, then global reserves, and eventually straight into gold. And that is where this story gets much more serious. Now let's move one level deeper, because the real risk isn't simply how much money governments are spending. The bigger question is what happens when geopolitical ambition starts colliding with financial constraints. The speaker's argument is that the United States has spent decades building a system around global military and financial dominance, while the cost of maintaining that system has increasingly been financed through debt. He argues that the wars, defense spending, and strategic commitments are ultimately adding to a debt burden that future generations will have to carry. Whether you agree with the political interpretation or not, there is a macroeconomic question here that cannot simply be ignored. Debt has a carrying cost. And that carrying cost becomes particularly important when interest rates are no longer near zero. For years, investors became accustomed to a world where governments could borrow enormous amounts of money at extremely low rates. That environment made debt appear almost painless. But the mathematics changes when borrowing costs rise. Every new bond issued carries an interest obligation. And as old debt matures, governments have to refinance it. If the new interest rate is higher than the old one, the cost of servicing that debt gradually increases. This is where fiscal policy starts interacting interacting directly with monetary policy. The government wants to spend, the Treasury needs to borrow. The bond market needs to absorb that borrowing. And the Federal Reserve is watching inflation, employment, and financial conditions at the same time. Now imagine geopolitical tensions continue increasing. Governments want stronger militaries. They want larger defense budgets. They want domestic manufacturing. They want energy security. They want semiconductor capacity. They want artificial intelligence infrastructure. They want resilient supply chains. All of these priorities may have strategic logic, but they also require capital. And if that capital is not financed through higher taxes or immediate revenues, debt becomes one of the mechanisms used to fund it. This is why I would not analyze military spending as a purely geopolitical story. For a macro analyst, it is also a fiscal story. And for a Boolean analyst, it eventually becomes a monetary story. Because when fiscal requirements become large enough, markets begin asking a much more uncomfortable question. Who ultimately absorbs the cost? Bond investors, taxpayers, the currency, or future generations? There is no free option. Someone pays, and the market can price that cost in several different ways. It can appear through higher treasury yields. It can appear through inflation expectations, it can appear through a weaker currency, it can appear through higher taxes, or it can appear through financial repression, where policy keeps borrowing costs below the rate of inflation for extended periods. And every one of these mechanisms has implications for gold. This is why gold is so interesting in a heavily indebted economy. Gold does not solve the debt problem, but it can become a hedge against the consequences of trying to solve the debt problem. If governments respond to excessive debt with higher real interest rates, gold can face pressure. But if governments respond with policies that keep nominal rates below inflation, the real return on cash and bonds can deteriorate. That environment can be supportive for gold. So the key isn't simply the size of the debt. The key is how policymakers choose to manage it. That is a distinction investors often miss. A country can carry high debt for a long time without a crisis. Japan is an obvious example of how complicated the relationship between debt, yields, inflation, and currency can become. So, high debt by itself is not a timing signal, it is a structural variable. The timing signal comes when markets begin to doubt whether the existing policy framework can manage that debt without creating another problem. And this is where the transcript's argument about a potential financial bubble becomes important. The speaker says the US stock market is highly inflated and argues that major technology companies are significantly overvalued, while also connecting parts of the technology sector to Pentagon spending. Again, those are strong claims. We should not simply accept the phrase biggest financial bubble in history as an established fact, but the underlying relationship between technology investment, government spending, valuations, and debt is worth examining. Because the modern economy is increasingly dependent on a relatively small group of enormous technology companies. These companies are investing aggressively in artificial intelligence, data centers, chips, and infrastructure. At the same time, governments are increasing spending on defense technology, cybersecurity, drones, and artificial intelligence. That creates an enormous intersection between public spending and private technology. And if investors begin pricing those companies as though extraordinary growth will continue indefinitely, the risk becomes asymmetric. The upside is already embedded into valuations. The downside may not be. If expected growth slows, valuation multiples can compress. If financing costs rise, speculative assets can reprice. If government spending changes, some revenue expectations can change with it. And if the broader credit system becomes stressed, highly valued technology assets can become particularly sensitive to liquidity conditions. This matters for gold because gold often sits on the opposite side of the liquidity spectrum. When investors are confident, capital tends to flow toward productive assets, equities, and higher risk investments. When confidence falls, investors begin looking for liquidity and protection. Gold can benefit from that shift, but again, not necessarily immediately. During the first stage of a major market sell-off, investors may sell gold along with everything else to raise cash. The important question is what happens afterward. If policymakers respond with aggressive easing, if real yields decline, and if investors become increasingly concerned about debt sustainability, the environment can change rapidly. That is when gold can move from being a defensive asset to becoming a monetary hedge. And there is another important development happening underneath all of this. The world is becoming less economically uniform. The transcript points to the rise of China and argues that American investors underestimate how rapidly other parts of the world are developing infrastructure and technology. That observation matters because the old global system was built around a relatively clear hierarchy. The United States had enormous economic power, The dollar dominated global finance. American financial markets attracted capital from around the world, and U.S. Treasury securities were central to the global reserve system. But a more multipolar world creates different incentives. China wants strategic independence. Russia wants strategic independence. Other emerging economies may want more room to maneuver between major powers. And Europe faces its own complicated relationship with energy, defense, and economic security. This doesn't mean the dollar suddenly disappears. It means the global financial system can gradually become more diversified. And gold can benefit from diversification without replacing the dollar. That point is extremely important. A country does not need to abandon the dollar completely to buy more gold. It simply needs to decide that holding 100% of its reserves in another country's financial assets carries unnecessary concentration risk. That is a much more realistic mechanism, and it helps explain why geopolitical tensions can support gold even when inflation is relatively contained. Gold can become a reserve diversification asset. It can become a hedge against sanctions risk. It can become a hedge against currency fragmentation, and it can become a neutral asset in a world where major powers increasingly distrust one another. Now think about the long-term consequence. If the world becomes more multipolar, central banks may want a reserve asset that doesn't belong exclusively to any one geopolitical bloc. That is gold's unique advantage. The dollar is powerful because the United States has deep financial markets, enormous liquidity, and a large economic system behind it. Gold has a completely different advantage. It has no issuer, and that makes it politically neutral in a way that sovereign currencies cannot fully replicate. This is why I think the geopolitical story could be one of the most important long-term drivers of gold. Not because every geopolitical conflict sends gold higher. It doesn't. But because prolonged strategic competition can change how governments think about reserves. And reserve behavior can change the structure of gold demand. This is where the story moves from short-term trading to long-term positioning. A trader might buy gold because they expect the next inflation report to disappoint. A central bank can buy gold because it expects the international monetary system to remain uncertain for the next decade. Those are completely different motivations. And if more institutions begin thinking like the second investor rather than the first, the gold market can experience a structural shift. But there is another question we have to answer. What happens if this geopolitical fragmentation also creates a stronger push toward alternative financial systems? Because if countries begin building payment networks, trade relationships, and reserve structures outside the traditional Western system, the consequences could extend far beyond currencies. It could affect commodities, it could affect energy pricing, it could affect cross-border settlement, and it could ultimately affect the role of the dollar itself. That does not mean the dollar is about to collapse, but it does mean the world may be slowly moving from a system of concentration toward a system of diversification. And whenever financial concentration decreases, gold becomes more interesting because gold doesn't need to replace the system. It simply needs to become one of the assets people use to hedge the system. That distinction could be the key to understanding the next major gold cycle. And now we need to look at the most dangerous part of the entire argument. What happens if the debt doesn't simply keep rising, but the market begins to question the quality of the debt itself? Because once investors start demanding a larger risk premium to finance the government, treasury yields can move higher. And if yields rise too far, the cost of servicing the debt becomes even larger. That can create a feedback loop. Higher yields, higher interest costs, larger deficits, more borrowing, more treasury supply, and potentially even higher yields. It is not inevitable, but it is a mechanism every macro investor should understand. And if that feedback loop ever becomes powerful enough, the consequences would extend far beyond the bond market. The dollar would become part of the story. The Federal Reserve would become part of the story. Inflation expectations would become part of the story. And gold would be sitting right in the middle of all of it. Because when investors start questioning the sustainability of the financial system, they don't necessarily ask, which stock should I buy? They start asking, what asset do I want to own if the assumptions behind the system change? That is the question that can transform gold from a commodity into a monetary hedge. And if the geopolitical pressures described in this transcript continue to intensify, that question could become increasingly important. But there is still one piece missing, because if geopolitical fragmentation is truly becoming structural, we need to understand what it means for the dollar treasury market and global reserve system over the next several years. And that is where the gold thesis becomes even more powerful and much more. Now we get to the part of this story that could have the biggest consequences for gold, the dollar. Because geopolitical competition is one thing, military spending is another, government debt is another. But when all three begin interacting with the global reserve currency, the implications become much larger. The dollar sits at the center of the international financial system. It is used for global trade, financial transactions, reserves, commodities, and cross-border investment. That gives the United States an enormous financial advantage. advantage. But it also creates an important vulnerability. When the rest of the world owns large amounts of dollar assets, the stability of the US financial system becomes important far beyond America's borders. And this is where the geopolitical argument becomes directly relevant to bullion. The transcript presents the world as moving toward a more fragmented geopolitical structure, with the United States facing increasingly powerful strategic competitors, particularly China and Russia. It also discusses Iran as another important geopolitical actor and argues that pressure against these countries has not produced the strategic outcomes Washington wanted. Whether we agree with that interpretation or not, there is a financial consequence worth watching. The more geopolitical competition increases, the more countries have an incentive to think about financial concentration. If your reserves are heavily concentrated in assets connected to another country's financial system, then geopolitical conflict can create an additional layer of risk. This does not mean countries suddenly stop using the dollar. It means they may want alternatives. And gold is one of the few alternatives that doesn't require choosing another country's currency. That is the key. If a central bank moves from dollars into euros, it is still choosing another sovereign currency. If it moves into yuan, it is choosing another sovereign currency. If it buys gold, it is choosing an asset without a sovereign issuer. That makes gold fundamentally different. And this is why the global reserve debate matters so much. The most important gold buyers aren't necessarily trying to predict the next Federal Reserve meeting. They may be trying to reduce strategic dependence. That is a much longer-term decision. Now let's consider the Treasury market. The US Treasury market is enormous and central to global finance. Government debt is constantly being issued, refinanced, and traded. As long as investors remain comfortable holding that debt, the system can absorb enormous amounts of borrowing. But confidence is critical. If investors begin demanding higher yields to compensate for fiscal or inflation risk, borrowing becomes more expensive. And that creates a difficult feedback mechanism. Higher yields mean higher interest costs. Higher interest costs can increase government deficits. Larger deficits require additional borrowing. Additional borrowing increases treasury supply. And if the market demands even more compensation, yields can rise further. Again, this is not a prediction that such a spiral must happen. It is simply a mechanism investors need to understand. Because if the market ever starts worrying about fiscal dominance, the consequences could be significant. Fiscal dominance is essentially the idea that monetary policy becomes constrained by the government's fiscal position. Imagine a situation where the Federal Reserve wants to keep rates high to control inflation, but high rates dramatically increase government interest costs. The political and fiscal pressure to lower rates then becomes much stronger. That doesn't mean the Fed will automatically surrender its independence, but markets may begin pricing the possibility. And once investors start thinking that monetary policy could become influenced by fiscal necessity, the traditional relationship between bonds, inflation, currencies, and gold can change. This is where gold becomes particularly interesting. Gold doesn't need the US government to default. It doesn't need the dollar to collapse. It doesn't even need the treasury market to fail. Gold can benefit simply from a gradual increase in the perceived risk surrounding sovereign debt and monetary policy. That is a much lower threshold, and it is also why I would be careful with the phrase de-dollarization. People often hear that word and imagine an immediate collapse of the dollar. That is not necessary. De-dollarization can happen at the margin. A central bank can reduce the percentage of reserves held in dollars. A country can settle a slightly larger share of trade in alternative currencies. Another central bank can increase its gold holdings. An investment fund can diversify its currency exposure. None of these actions individually destroys the dollar, but collectively, they can gradually reduce the dollar's dominance. And if that process continues for years, gold can become increasingly important as the neutral asset between competing monetary systems. This is one reason the geopolitical environment matters so much for bullion. A world dominated by one geopolitical center has different reserve incentives from a multipolar world. In a highly centralized system, holding the dominant currency may be enough. In a fragmented system, diversification becomes more valuable. And gold is almost perfectly suited to diversification because it does not represent another country's liability. This is also where the relationship between gold and the dollar becomes more complicated. Normally, investors think dollar up equals gold down, dollar down equals gold up. That relationship still matters. But what if the reason the dollar is rising is a short-term liquidity shock? Gold can fall. What if the reason the dollar is weakening is a long-term loss of confidence? Gold can rise. Same currency, different mechanism. This is why macro analysis has to go beyond correlations. You have to understand causation. A dollar rally caused by stronger US growth is not the same thing as a dollar rally caused by global panic.